What is a Roth IRA? Am I eligible? How much can I put in? What happens if I'm not eligible? These are all good questions. We're going to cover them in Ask Alex Anything this week, starting with what is a Roth IRA? It is the most powerful retirement vehicle that we have available to us in the United States. It is essentially a vehicle that you can put money into after tax today. It will grow tax deferred into the future. And after you reach age 59 and a half in retirement, every dollar you take out is tax free. Super powerful, especially if you start at a young age. There's lots of nifty ways to even get your kids contributing to Roths from a really, really young age. Special advantages, especially if you are a small business owner or own your own enterprise or have a side gig that you can employ your kids. Lots of really cool stuff you can do to get money in retirement accounts for your kids. But let's talk about the more practical aspect. What about us adults here? Who is eligible to contribute? Basically, everybody is eligible with some caveats and with some nifty planning. The simplest way to explain it is if you have earned income, you can put money into a Roth. But there's a catch. If you are a single filer and you make over $165,000, no Roth for you. Same thing, married filing jointly. If you're over $246,000, at least by 2025 tax law, no Roth IRA contributions for you either. So the question is, how do I get money in a Roth if I make too much money and my adjusted gross income is too high? Great question. That is this fun and exciting tactic of a backdoor Roth. This is pretty neat. It's not terribly confusing. All you do is make a non-deductible contribution to an IRA, one that you would set up special. Certainly can't commingle that if you have any other types of IRAs floating out there in the ether. You don't want to try this strategy. It'll be a nightmare for your CPA, and even worse if you do your own taxes on TurboTax. I digress. The point of this is put the money in the non-deductible IRA, and then you immediately convert it to Roth. It functions the same way, but it's essentially a way to circumvent the basic IRS rules on Roth eligibility. Next up is, what is a Roth conversion? People talk about these all the time. There are good times and bad times to do Roth conversions, which we're going to get to in just a second. But first and foremost, a Roth conversion is when you take a pre-existing IRA of any kind. It can be a SEP, simple, whatever. It can be any kind of traditional post-tax or a pre-tax IRA, and you convert all or a portion of it to Roth. The way this works is essentially you will pay tax on the conversion amount at your ordinary income tax bracket now, and then that money will grow in the Roth into the future for future tax-free distributions after age 59 and a half. Sometimes you want to look at doing this is if you have a change in employment, your income is way down. For people in certain highly cyclical sectors, they may have a year where they make tons and tons of money and they're in the top tax bracket. The next year it's much slower, like real estate agents, something like that. If you're in a year where your income is way down and your tax bracket's super low, you can look at converting some of your IRA in those years so you're paying a lower tax amount to have tax-free distributions in the future when your taxes might be higher. Secondarily, bear markets. This is the making lemonade out of lemons scenario. Let's say you start with $10,000 in an IRA. The market is horrible. It's like the financial crisis of 2008 all over again. Your $10,000 goes down to $5,000. We're all really sad about that. But what you can do is you can then subsequently take that $5,000, you can convert it to Roth, only pay tax on the $5,000. And when the market recovers in a few years, when that $5,000 is worth 10 again, that's no longer a taxable distribution when you take it out. It's a tax-free distribution. Super powerful. You're kind of paying it forward to your future self. There is a catch with Roths though. There is a 5-year waiting period if you are under the age of 59 and a half before you can take money out. And that also applies even if you're a young buck and let's say you put $5,000 in a Roth back in 2020 rather. And that grew to $10,000 in 2025. The 5-year wait is up. If You have all sorts of crazy stuff happen. Your water heater goes out, you got cracks in your driveway, windows are broken, somebody got sick, none of this stuff is covered by insurance. You need to get access to a little bit of money. You can actually get access to that $5,000 that you put in over 5 years ago. You can take it out without penalty, but you can't take out a nickel more, otherwise you're gonna pay income tax and a 10% penalty. This is why when you start diving into the world of Roths and some of these more advanced strategies, like finding ways to open Roths for your kids, doing Roth conversions, and trying to model for if it makes sense for you to financially do Roth conversions, you have to work with a financial professional, or you have to do a hilarious amount of research to make sure you don't make a mistake. Last thing you want to do is mix up cost basis with traditional IRAs, having to track that forever and then file multiple amended tax returns. So do your homework or work with a professional if you're going to try any of these strategies. Reach out to the team at info@cfgfinancialplanning.com if you want any more information. Thanks so much. Happy Easter. You all take care.